Hello everyone and welcome back to the sessions on fixed income for CFA Level 1. In continuation of fixed income securities, in this class we are going to focus on valuation aspects. So you may please put the title Valuation of Bonds. So right from the point when we were learning time value of money, we have understood one thing, that value of any kind of fixed income security like bond will be straight away the present value of all the cash flows that is offered by such instrument. So if you precisely look at bond is a fixed income instrument. It is promising you to pay defined amount of cash flows at defined dates. These cash flows will include the coupon payments and the par value or the face value of the bond, which will be payable on redemption or on maturity. So the fundamental concept that you apply over here is the present value of the bond will be nothing but the present value of its cash flows. Cash flows are defined, that means definite amount of cash flows at definite dates, resembling coupon payments and the principal, or you can call it the par value or face value. And to bring down these cash flows to their present value, you need an appropriate discounting rate. Now, about discounting rate, I am going to explain some important aspects in detail, because many a times I have noticed that candidates commit mistakes in adopting the appropriate discounting rate. What happens when you just have bookish knowledge and you have certain set parameters as a procedure in your mind, but you are not clear with the concept, you may commit such errors. The discounting rate to be adopted by the investor should be the required rate of return. When I ask this question to candidates, they have one answer. They tell me, sir, the discounting rate has to be YTM. Do you know, discounting rate can be YTM under certain circumstances. Discounting rate will have to be the required rate of return by the investor under other circumstances. It all depends on what is the purpose of your calculation. Like for example, I want to arrive at the quoted market price of bond. That means all the bonds future cash flows I want to bring down to their present values in such a way that the present value must match with the quoted market price of the bond. What is the bond's price prevailing now? If you stick to that and you want the present value to resemble the quoted market price, then the discounting rate has to be the YTM, that is yield to maturity, because yield to maturity indicates the internal rate of return for the bond investor. On the other side, there is something called fair valuation. When you want to assess the proper value of a bond, for example, if a bond is quoted at say $89.6, now whether at that price you should buy the bond or whether at that price you should sell the bond, that you have to first decide. And the quoted market price is the actual price. You would want to assess the fair value. The fair value of the bond is what you need to compute. Now logically, when I tell you that determine the bond value, you know, you are not determining the bond price, you are determining the bond value. See, bond price is quoted in the market. That is not to be calculated. What is to be calculated is the fair value of the bond. So the fair value of the bond, if you want to arrive at, you have to look into what is the required rate of return by the investor. This can be identified as the investor's desired yield rate. So YTM is yield to maturity. That means the yield offered by the bond, but what is the yield expected by the investor? Both these yields may not be the same, correct? For example, a bond is providing yield of 8% per annum, but the investor is expecting an yield of 9% per annum. Is it possible or not? Yes, it is possible. Therefore, you will compare the required rate of return by the investor with the YTM of the bond at a little later stage and draw conclusions from there. But as of now, the focus point is we have to determine the value of the bond at present. So, the present value of any fixed income instrument will be the present value of all its future cash flows. Once again, I would say the bond, being a fixed income security, has promised to pay you the definite amount of cash flows at definite dates. These definite payments resemble the coupon payments and the par value or the maturity value or the principal that will be repaid to the investor on maturity. So, definite cash flows at definite dates in future are being promised. You need to arrive at the present value, and for that purpose you need to arrive at an appropriate discounting rate. If the scenario is asking you to determine the current market price of the bond, that means you want the present value matching with the current market price, the discounting rate has to be that rate which will connect the future cash flows with its quoted market price today, and that is the internal rate of return of the bond or YTM of the bond, yield to maturity. But if you want to arrive at the fair value, now when I say fair value, do you know what I exactly mean? If I am the investor, how much am I willing to pay for that bond? Keep that thing into your notice. How much am I willing to pay for that bond is its fair value. So, to arrive at that value, the discounting rate has to be the required rate of return. At a little later stage, I will have a vis-a-vis discussion between the required rate of return and yield to maturity. But as of now, let us do one thing. Let us write some notes on this title, that is valuation of bonds, and we then take calculative examples to support our understanding. When valuing bonds, we use the present value concept to determine the current value of the bond's future cash flows. These cash flows include annual coupon payments, which are regular interest payments made to the bondholder, and the face value or the principal, that is the amount paid back to the bondholder at maturity. To value a bond, we discount each of these future cash flows back to the present value using appropriate discounting rate. Alright friends, once you have completed writing this much, let us move ahead and continue further. Required rate of return. The required rate of return by the investor plays a crucial role in valuation of bonds. It represents the minimum return an investor expects to receive for taking on the risk associated with the bond. Now please keep this thing into your notice that when we say a required rate of return, it necessarily resembles the minimum rate of return that the investor is expecting. If the investor is getting any rate higher than that, investor is always going to be happy. This is always considered as a cutoff rate or the minimum expected rate of return. Investor is not willing to compromise with the rate of return. So, one more thing, from where do we get this required rate of return or the desired rate of return for the investor? It is basically a reference rate. Let me explain this point to you. Suppose in the market, I am talking about the bond market, there is a particular bond which is A rated bond, which is offering 9% yield. That means I have an opportunity to invest in that bond which is offering me 9% yield, and maybe similar other bonds are also somewhat offering 9% yield. That means for A rated bond, to the risk class it belongs, I am expecting a 9% return as an investor. I won't compromise for a return lower than that, because if I don't get an opportunity to invest in one particular bond, there are other bonds available, I can invest into that. If I am not investing in those bonds and investing in this particular bond, which by credit rating and risk rating is at parity, then I must be compromised for what I have sacrificed over there, and that is my opportunity cost. My opportunity cost over there being 9%, it becomes my required rate of return. I will not compromise for any rate below 9% in that scenario. So I'm sure you understand that what is the source of any particular required rate of return by the investor. Let me just put forward another example. Suppose there is a bond which is A rated bond which is offering 9% yield, but the bond that I am thinking to buy is say a B rated bond. B rated. Now, B rated bond obviously will be riskier as compared to A rated bond. In the market we have no parameter to compare. We do not have any other bonds of B rated type to evaluate what could be the required rate of return for a B rated bond. Now what do? I identify one thing, that for A rated bond my required rate of return is 9%. For B rated bond I need to make some additional risk adjustment to my required rate of return. Suppose the risk premium that I consider for the additional risk that I am going to take by investing in B rated bond, where I have an opportunity otherwise to invest in A rated bond. So I am compromising 9%, but I cannot just be happy with 9% return that I get from bond B. That is B rated bond. If it is offering me 9%, I don't want to invest. It has to offer me some additional return so that it compensates the additional risk that I am taking. So assume that on absolute basis 100 basis points were added to the A rated bonds yield to arrive at the required rate of return for the investor for a B rated bond. So what would be your required rate of return in that case for a B rated bond? 9 plus 1, 10% will be the answer. So I am sure you people are getting the idea about how to arrive at the required rate of return for a bond investor. Let's continue with the notes writing part over here. For determining the value of the bond, the required rate of return by the investor is considered as the discounting rate. The required rate of return directly impacts bond valuation. Investors use this rate to determine the appropriate price they are willing to pay for a bond, ensuring that the investment meets their return expectations given the risk involved. Alright friends, once you have completed writing this whole thing, let us move ahead and continue writing further. The required rate of return, RRR, is used as the discount rate when calculating the present value of future cash flows from a bond. For bonds, this includes the annual coupon payments and the face value at maturity. The higher RRR implies a higher discounting rate, which reduces the present value of future cash flows, leading to a lower bond price. Conversely, a lower RRR means a lower discount rate, increasing the present value of future cash flows and rising the bond price. Now here, just for you to be reminded of one thing, earlier when we were learning quantitative methods, in that subject we came across interrelationship between the present value of any cash flow and the selected discounting rate. The higher the discounting rate, lower will be the present value, and vice versa. And we have learned one thing, that the present value of cash flows will always share inverse relationship with the discounting rate. So higher the discounting rate, lower will be the present value, and vice versa. So we have learned these things. Same concept applies even in bond investment. So quickly take note of these notes. Alright friends, once you have completed writing this whole thing, let us move ahead and take up calculative examples to understand the concept. Consider the following information about a bond: face value, $1,000, annual coupon rate 6%, maturity 5 years, required rate of return by investor 6%, determine the present value of the bond. Now, most of the candidates would make calculations without even touching their calculator when it is a question like this. And the answer, I'm sure most of you would have got the answer by now. The answer will be $1,000. And that is correct answer, obviously. Here you don't need your calculators. What is the coupon rate offered by the bond? 6% in this example. And what is the required rate of return by the investor? Even that is 6%. Means the investor is expecting exactly that rate which is matching with the coupon rate, and the bond is going to provide the maturity value as the par value only, not a penny less, not a penny more. As a result, whatever be the par value of the bond, that will be the present value of the bond. So fundamentally, if you still would want to determine the present value of all the cash flows that the bond is offering, considering 6% as discounting rate in this example, the present value computed by you will still give you $1,000. Conceptually, it has to be $1,000. So the real calculation will be needed when there is a mismatch between the coupon rate and the required rate of return. If required rate of return is higher, means the discounting rate is higher, the value of the bond will decline. As I have explained to you earlier, that the bond value will have inverse relationship with the discounting rate. So let us look into the solution to this particular example. Value of the bond is calculated as follows. VB, which indicates the value of the bond, will identify all the future cash flows and discount all these future cash flows to their present value. Now look at one thing, 6% is the annual coupon rate, and 6% into $1,000 will give you $60 every year. So 60, 60, 60 every year for 5 years, and 5th year end, along with that 60 as coupon payment, you will also receive the par value of the bond, that is $1,000. Therefore, it is given as aggregate, that is 1,000 plus 60, that is $1,060, and all these cash flows receivable after 1 year, after 2 years, after 3 years, after 4 years, and after 5 years are discounted using a uniform discounting rate, that is 6%, which is representing the required rate of return by the investor. Now, when you make this computation, the value of the bond would come to exactly $1,000. Alright friends, once you have completed writing this whole thing, let us observe the calculations on your financial calculator. Even though this particular example did not require any such calculations to be made by you. So your BA2 plus financial calculator, keep it ready in your hand. We are talking about steps for computing present value. So how do you initiate? You initiate, once you turn on your calculator, you press the second and FV for TVM. I'm sure you know the location of these buttons on your calculator. This is the second switch and this is FV. When you do this, it will clear all the TVM calculations which might be stored in calculator's memory. So second and TVM is what you need to apply, second and FV for clearing TVM. Then next thing you have to do is all the inputs. You know one thing, that this line in your calculator, this row of buttons, these represents all those required values to be given as input for any kind of time value of money calculation, any kind of TVM calculation. N represents number of years, I by Y is the rate of return, PV is the present value, PMT is the annual payment, and FV is the future value. So we are supposed to find present value. So the PV calculation we have to do. So we cannot provide the input of PV. PV is what we have to determine. But all other inputs in a sequence we will start giving. So after clearing all the TVM calculations, what you do is input 5 and this press N. So input 5 and then press N. then your discounting rate being 6%, so input 6 and press I by Y, 6 and I by Y. PV is what you have to compute, so skip that switch. And now annual coupon payment is 60, so input 60 and then press PMT. This is PMT, input 60 and press PMT, and then input 1000 and press FV. Once you have given all these inputs, your calculator is ready to calculate the missing value, that is the present value. So now what you need to do, combination of these two switches, CPT stands for compute and you need to compute PV. So you have to press CPT followed by PV. So press CPT and then press PV. The result that you obtain after pressing CPT and PV will be the result as PV equals to negative 1000. I am sure from the context of time value of money, you do recollect one thing, that if all the bonds future cash flows you are going to receive, then the bonds present value today you have to invest. Today you have to invest means that is going to be a cash outflow, and cash outflow your calculator understands as a negative cash flow. That is why it will provide you the present value by default as a negative, but you may not write your final answer as a negative 1000 as present value. The bond price or the bond value cannot be a negative value, you know that, right? It is still going to be a positive value, but your calculator will always provide that with a negative sign, and you know the reason why it happens like that. Alright friends, once you have completed all these calculations and you have written these steps, let us move ahead and take up the next example. Now this example, that is example 2, conveys one thing. It says consider the following information about a bond: face value $1000, annual coupon rate 6%, maturity 5 years, required rate of return by the investor is 5%. Determine the present value of the bond. Now before even touching your calculator, looking at this example, just use your simple common sense, because in examination if your common sense is working all the time, most of the questions you will be able to crack just by applying your common sense without even touching your calculator. What you have to understand is, the bond's par value is $1000, bond is giving you 6% coupon rate, and your expected rate of return as an investor is just 5%. Means bond is offering you a return more than what you expect. So for you, the bond is worth even beyond $1000. So the present value of the bond has to be above $1000 definitely. Now without calculator, I can assure that the value has to be above $1000. But how much that value will be, that I cannot compute without the calculator usage. For that I will need calculator. For example, on this question, the 3 alternative answers that you get in your exam is say $990, $1000 and some value above $1000. It is obvious that the value above $1000 will be correct. So you don't have to touch your calculator for answering that question that time. However, if all the 3 values are given above 1000, then which is the nearest value? For that you have to obviously use your calculator. So let us look into what will be the calculations over here. So the bond's cash flow pattern will be same as we have seen in the earlier example, but this time the discounting rate is going to be 5%, and we know fundamentally the value of the bond will be greater than $1000. So when you make the calculation, it is coming to $1043.29. So $1043.29 is the final answer. That is the value of the bond at present. Alright friends, once you have completed these calculations, let us look into how would you present this calculation on your financial calculator, BA2+. So steps for computing the present value we have just seen in the earlier example, same steps to be followed. So don't forget to turn on your calculator, and first thing you need to do is press second and then FV for clear TVM, second and FV. Now start giving all the required inputs one by one. So input 5 and then press N. Then again input 5 and press I by Y. Now this is because your expected rate of return or required rate of return for the investor is 5%. Input 60 and then press PMT. This is the input given for annual coupon payment, and then input 1000 and press FV. This is for the par value that you are going to receive on maturity. And finally, you need to compute the present value. Your calculator is ready. So press CPT and then press PV. CPT followed by PV, and you get the result as PV equals to negative 1043.29. And you know one thing, that the present value of this on calculator it is appearing as negative, but the correct answer will be a positive value, $1043.29. Alright friends, once you have completed writing this entire procedure, let us move ahead and take up the next example. In this example again everything is exactly the same, but now the required rate of return by the investor is 8%. Looking at this example, which is exactly similar to the previous example, but now what we see is the required rate of return by the investor is higher than the annual coupon rate, and one thing is for sure, the present value of this bond is definitely going to be lower than $1,000, and computation process will be exactly the same. Fundamentally the calculation will be made this way, and when you discount all these cash flows to their present value using 8% discounting rate, the present value comes to $920.15. Alright friends, once you have completed writing this whole thing, let us move ahead and let us observe the calculations on your financial calculator. So steps for computing the present value, all same steps. Just for a caution, I am displaying these steps on screen. Press second and then FV for clear TVM. You must do this all the time. Then input 5 and press N. This is for 5 years of maturity. Then input 8 and press I by Y for discounting rate being 8%. Input 60 and then press PMT for your annual coupon payments. Then input 1000 and press FV for the par value to be received on maturity, and finally ask your calculator to give the result. So press CPT and then press PV, CPT and then PV for computing the result as PV equals to negative 920.15.